Welcome to another 8 Facts video. Today we will go through ChatGPT's top 8 most important facts about minimizing your taxes. This list is a good introduction to some of the key principles and loopholes for you to be aware of when preparing for the financial year's end in the USA. Please note that this video does not constitute financial advice, and should only be taken as pointing you in the direction of professional resources. I'll also be releasing shorts that further explain individual components of these facts. Before watching, make sure to like and subscribe for more content. Now, let's get into our list. 1. Taxes can be slashed through the use of deductions, credits, and exemptions. Deductions reduce taxable income, credits reduce tax liability, and exemptions remove certain sources of income from taxation. Making use of these is a highly effective way of lowering your tax liability. Common deductions include charitable donations, mortgage interest, and business expenses. Credits reduce your tax liability dollar for dollar, and can include the Earned Income Tax Credit, Child Tax Credit, and education credits. Exemptions remove certain sources of income from taxation, such as Social Security benefits and certain types of investment income. In order to take advantage of these deductions and credits, you must understand what is available and how to claim them. The Internal Revenue Service, IRS, offers a variety of resources to help taxpayers understand their tax obligations. Additionally, professional tax preparers can provide guidance and assistance in claiming deductions, credits, and exemptions. By making use of these resources, you can maximize your tax savings and reduce your tax liability. The IRS website sections on credits deductions for individuals and education credits deductions are excellent places to find more detailed information. Sources are listed in the description and comments below, specifically sources 1, 2, and 3. 2. Tax-advantaged accounts, such as 401ks and Roth IRAs, allow you to save money for retirement while deferring or avoiding taxes. A 401k is a retirement savings plan sponsored by an employer. Contributions to a 401k are made before taxes, which means that you can reduce your taxable income by contributing to one. Roth IRAs are individual retirement accounts that allow you to contribute after-tax dollars, which are then allowed to grow tax-free. The amount that you can contribute to a 401k or Roth IRA each year is limited by the Internal Revenue Service, IRS. Generally, you can contribute up to $19,500 to a 401k in 2020 and up to $6,000 to a Roth IRA in 2020. Additionally, if you are aged 50 or older, you can contribute an additional $6,500 to a 401k and an additional $1,000 to a Roth IRA. The potential tax savings from these accounts can be significant. By investing in a 401k or Roth IRA, you can reduce your taxable income and potentially lower your tax rate. Additionally, the tax-free growth of funds in a Roth IRA can provide a major boost to your retirement savings. Investing in tax-advantaged accounts is a great way to make the most of your retirement savings while reducing your tax liability. For more information, see sources 4, 5, and 6. 3. Tax-free investments. Certain investments, such as municipal bonds, are exempt from federal or state taxation. Municipal bonds, also known as munis, are debt instruments issued by state and local governments to raise funds for public projects. These bonds are typically exempt from federal taxation, as well as from state taxes if they are issued in the state of residence. This makes them attractive to investors who are looking to reduce their tax burden, as their interest income is not subject to taxation. Additionally, municipal bonds are generally considered to be low-risk investments, making them a good choice for more conservative investors. Municipal bonds can be purchased from brokers, banks, or directly from the issuer. Investors should research the issuer thoroughly before investing in a bond, as the issuer's ability to repay the bond will affect the bond's value. Additionally, investors should be aware that municipal bonds may be subject to the Alternative Minimum Tax, AMT. Overall, municipal bonds can be an attractive option for investors who want to minimize their tax liability. However, investors should always research the issuer thoroughly and consider their own financial situation before investing in a muni bond. See sources 6, 7, and 8 for more info. 4. Health Savings Account HSA, contributions. Contributions to an HSA are tax deductible, and the funds can be used to pay for medical expenses. The Health Savings Account, HSA, is a tax-advantaged savings account designed to help individuals pay for medical expenses. Contributions to an HSA are tax deductible, and the funds can be used to pay for qualified medical expenses without being subject to taxation. An HSA can be used to cover costs such as doctor visits, prescription drugs, and medical equipment. HSAs are offered alongside high-deductible health plans, which require individuals to pay a higher out-of-pocket deductible before insurance kicks in. HSAs offer several advantages to individuals and families. First, contributions to an HSA are tax deductible, which can provide a significant tax benefit. Second, funds in an HSA can be used tax-free to pay for qualified medical expenses. Finally, HSAs can be used as a retirement savings vehicle, as funds are allowed to accumulate and grow tax-free over time. Overall, the Health Savings Account is a valuable tool for individuals and families looking to save money on taxes and pay for medical expenses. Before opening an HSA, it is important to understand the details of the HSA plan, including any fees or restrictions associated with the account. For more information on HSAs, individuals can consult the IRS website or speak to a financial advisor. 5. Relocating to a lower tax jurisdiction. Moving to a state or country with lower taxes can reduce your tax liability. Relocating to a lower tax jurisdiction can be an effective way to reduce your tax liability. Moving to a state or country with a lower tax rate, or one with more generous deductions, exemptions, or credits, can help to save you money. For example, some countries, such as the United States, have notable capital gains tax, while others, such as the United Kingdom, have a lower capital gains tax rate, and others still, such as Malaysia, have none at all. When considering relocation for tax purposes, it is important to consider the full impact of the move. In addition to the tax implications, you should consider the cost of living, job opportunities, and other lifestyle factors. Additionally, you should be aware of any tax implications that may exist when you return to your home country. For example, some countries may tax income earned while abroad. Relocating to a lower tax jurisdiction can be a great way to save on taxes, but it is important to consider all of the factors involved before making the move. For more info, see sources 9, 10, and 11. 6. Tax deferred exchanges. Exchange investments, such as 1031 exchanges, allow you to defer taxes on the sale of an investment property. A 1031 exchange, also known as a like-kind exchange, is a type of exchange where an investor can exchange a real estate property for another real estate property of a like kind without incurring capital gains taxes. This type of exchange allows investors to defer capital gains taxes until the time of sale, thus increasing the amount of money available for reinvestment. The 1031 exchange is a powerful tool for investors looking to acquire more investment property without incurring immediate tax liability. To qualify for a 1031 exchange, the property being exchanged must be of like kind, meaning it must be a real estate property exchange for another real estate property. Additionally, the investor must establish a qualified intermediary to facilitate the exchange and must complete the exchange within 180 days of the sale of the initial property. 1031 exchanges can be a great way to increase the amount of money available for reinvestment and to defer taxes on the sale of an investment property. However, the process is complex and investors should consult a tax professional to ensure they are taking full advantage of the tax benefits available. Additionally, it is important to remember that capital gains taxes will be owed when the property is eventually sold. Sources 12, 13, and 14 have more information on the topic. 7. Tax-efficient investment strategies. Investing in low-cost index funds and tax-managed funds can help minimize the tax impact of your investments. It involves making smart investments that minimize the amount of taxes you pay on investment returns. By investing in low-cost index funds and tax-managed funds, you can reduce the amount of taxes you pay on investments, maximizing the potential for long-term wealth accumulation. Index funds track a particular index, such as the S&P 500, and usually offer lower fees than actively managed funds. Because index funds are passively managed, there are fewer trading costs, which can help lower the taxes you pay on investment returns. Tax-managed funds are designed to minimize taxes on capital gains and dividends and help investors create a more tax-efficient portfolio. Tax-efficient investing is an important part of any investor's strategy. By taking advantage of tax-efficient investments and strategies, investors can reduce their tax liability and maximize their long-term wealth accumulation. It is important to consult a financial advisor to ensure that your investment strategy is properly aligned with your financial goals and that you are taking advantage of all available tax-efficient options. The relevant sources are 15, 16, and 17. 8. Maximizing deductions. Making sure to take advantage of all available deductions, such as student loan interest and charitable donations, reduces your taxable income. Maximizing deductions is an important part of minimizing tax liability. When it comes to deductions, there are a number of options available, depending on an individual's circumstances. Student loan interest, for instance, is a deduction that is available to those who are paying off their student loans. This deduction can be worth up to $2,500 for the 2020 tax year. Similarly, charitable donations are deductible up to a certain amount. Individuals can also take advantage of deductions for medical expenses and state and local taxes, as well as a number of other deductions. When filing taxes, it is important to make sure to take advantage of all available deductions. This can help to reduce taxable income and, ultimately, reduce a taxpayer's overall tax liability. Additionally, deductions can be used to maximize eligibility for tax credits, such as the Earned Income Tax Credit, EITC, which can provide a valuable tax benefit to lower-income households. In order to maximize deductions and reduce taxable income, it is important to keep detailed records throughout the year and to consult with a tax professional when filing taxes. Knowing which deductions are available, and how to properly claim them, can help individuals maximize their tax savings. Additionally, tax software can help taxpayers identify deductions that they may have missed and estimate the potential impact of taking advantage of those deductions. With fact number 8, we conclude our list of our top 8 most important facts about minimizing your taxes according to ChatGPT. We thank you for watching and encourage you to check out our other videos. A reminder, all sources are in the description and in the pinned comment. We also hope to get your thoughts on this AI program in the comments below. Remember to like and subscribe for more facts about a range of topics.